My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends, just try to make a little money. My job, not just entertain, but to educate, teach. Call me at 1-800-743-CNBC. Tweet me at Jim Cramer. In this business, we spend too much time on the winners and not enough time on the losers that may turn out to be winners. And that was the feedback I got about last Thursday's show opener, where I analyzed the prospects of the 5 best performers Dow Jones Industrial Average for the first quarter. So on a day where the Dow lost 240 points, S&P declined 0.2%, NASDAQ actually inched up 0.11. I want to answer the question people put to me, which is, would I buy any of the Dow bow wows? The dogs of the Dow Jones Industrial Average, based on the declines in the first quarter. Normally, I don't believe in the concept of a stock pivoting in such a short period of time. 3 months is not a pirouette May. But I think companies can lay the groundwork, and I see some of them doing that. So let's get to the 5 worst performers from the first quarter, and I'll tell you the levels where the stocks could be enticing. By the way, I also want to take the liberty to include Walgreens, which was unceremoniously dumped. Sell, sell, sell. From the Dow just after 5 years of its inclusion. Let's take them from the bad to the truly abysmal. We'll start with United Health, which is bad, the nation's largest health insurer, with a stock that fell 6% in the quarter. Now, this stock was hurt by higher medical costs, just like Humana, which was one of the worst performers of the S&P. That was down 24%. Yet the managed care companies are still being hurt by the post-COVID hangover, where people who skipped getting surgery during the pandemic are finally getting treatment. I find this issue nagging. When does it end? We can't tell. And then tonight, to add insult to injury, the health insurers got some bad news about the medical advantage plans they sell. The government's not allowing them to have much of an increase in their policies. This news came out just after the bell. It is pretty negative, so I think you'll get a chance to buy these stocks well below tonight's close. I predict downgrades or maybe even some price target cuts. I also thought UNH's stock might have come down this quarter past because of that hack for Exchange Healthcare Unit, which keeps track of revenue and payment cycle. The February data breach is being heralded as one of the worst ever to hit the industry. My friends who are in the cybersecurity business say it is just horrendous. But Humana wasn't hit by the hackers, and it was an even worse performer for the quarter. Of the 6 losers I'm covering tonight, UNH probably has the best chance for a bounce back from where it bottoms tomorrow or Wednesday. I just wish it fell more, although the 5% decline tonight, today alone, plus another 5% tomorrow, makes it a lot more attractive. Next up is, Apple. I'll be very careful about what I have to say about Apple here. First, I've said this $170 stock could trade down to $160, its old 52-week low, because the company's thought to have no growth or may actually have down revenues. If the latter comes true, Apple actually have a hard time staying at $160. We know that sales in China apparently were down 17% for the iPhone in February. Average selling prices of older models have come down, too. Bad sign. Plus, there seems to be an inventory bubble developing in phones. It's all bad, people. At the same time, even after falling 10% in the first quarter, the darn thing still sells for more than 25 times earnings. That's too high given the negatives, hence why I say it needs to come down. But Apple does have 2 things going for it. First is the Developers Conference in June, where we might hear about some new exciting stuff, and arguably more important, we'll see if management embraces Jensen Huang's vision of the Vision Pro as an Omniverse-enabled tool for the enterprise, not just a consumer product that sits in your closet, as so many people are telling me. Now, in his keynote at NVIDIA's GTC event, Jensen did the unthinkable. He actually talked about doing business with Apple. The first rule of doing business with Apple is you don't ever talk about the name Apple. So he's got to be pretty confident of this stance. If Jensen can get a supercomputer Omniverse stream through Apple's Vision Pro to build digital twins of factories or help car dealers or realtors move product, then I think Apple's screaming by if it pulls back to the 150s. Of course, my long-term view has not changed. We own Apple for the trust, and I still say own it, don't trade it, because I am confident in the management team, and it's hard to swap out and swap in and swap back out, all that nonsense trading. I don't like it, not one bit. Short-term loser, long-term winner? I think so. Third, there's Intel, which could really rally simply thanks to easy comparisons versus last year. On top of that, this morning, UBS raises price target on Intel based on a very compelling but theoretical sum of the parts analysis. Given that Intel was down 12% in the first quarter, I wouldn't be surprised if it could bounce. CEO Pat Gelsinger has at times demonstrated flashes of brilliance, but even more bright hubris. which is always good for 3 or 5 points from the faithful flock. All Pat has to do is say that margins are going to get better, and that'll do it. And that's pretty, hey, margins will get better. Of course they are. Fourth on the Dow's loser list is Nike. Now, this one's rough. The shoe business has become quite competitive, with New Balance joining Hoka and On, shooting at Nike. I think the consumer's rebelling against anything that costs too much right now. Nikes are considered expensive. I think they got some positive press about the China business, but it's U.S. I'm worried about. Now, we own Foot Locker for the Travel Trust, and that's been a mistake, in part because it sells uninspiring Nikes. However, I'm beginning to believe that the whole lineup may be uninspired. Now, that said, historically, it's been hard to keep Nike stock down for long. I want to see this quarter, though, because I believe the consumers stopped paying up for some things that they can get for less competition. For instance, just tonight, PVH reported and gave a really ugly forecast. The stock was trading down 20%. That will most certainly bleed over to all the apparel companies, including Nike. Fifth, there's the dishonorable mention. The expelled Walgreens down almost 17% in the period, not including the near 10% hit it took today. Now, we had CEO Tim Wentworth on the show Thursday talking about a game plan, and I think you can turn this thing around within the year. I know that's not within the month or the current quarter. Wentworth's basically turning the stores into real pharmacies, and that could take a little time to rebuild. I think he can pull it off, though, but there's no hurry to buy this one. This story's going to take a long time to play out. Finally, there's the worst performer in the Dow, and that's Boeing. And everybody on Earth knows this thing is a dog because it gets so much well-earned bad publicity. We know Boeing needs to use a lot of its cash to buy Spirit Aerosystems to get control of the fuselage. That whole gambit to offload the building and parts on the plane clearly did not include quality control. Only by acquiring Spirit, perhaps for about $5 billion, $1 billion above where it's trading, can this company assuage the angry regulators who haven't been appeased even with the resignation of CEO David Calhoun. I believe they'll insist that Boeing bring in someone from the outside. Hard to blame them. And when they do, then you'll have a serious resumption in aircraft sales. But it won't be at the record pace that I've been hoping for, which means this one might be a long-term renter on the poorly performing list. Bottom line, though, the worst performers in the Dow include stocks that have been, let's say that they have both hair and flies on them in a market that demands a pristine story, and there's nothing pristine about this list. Do not kid yourself. Let's go to Rich in Nebraska. Rich!
Mr. Cramer, good afternoon, sir. Hey,
Good
I've got an
afternoon.
interest in OKE. I bought it at the COVID dip at around $27, and now it's pushing 80. Still giving me some great dividends, but should I hold on to this one? Or
I like ONEOK very, very much. And by the way, it still yields 5. Let's keep your position, and if it comes back down, I would actually buy more. That's how much I like it. Let's go to Vic in my home state of New Jersey. Vic!
Hey, booyah, Jim. First
Strong.
time, long time. Love your show. I try and watch every day with my daughter, 16-month-old Isabella. I got her set up with a 529. And
Perfect. That's what I want. Compound, reinvest, reinvest, reinvest. How can I help?
Love it, love it. Listen, I'm on Prudential. Buy, sell, or hold.
A stock is only $1 from its high in a market that I think is headed down because we're overbought. I want you, if anything, maybe a little schnitzel, take a little off the table. And then if it goes lower, we can buy it back. But right now it's up a little bit too much. All right. The dogs of the Dow so far have fleas, ticks, and even some broken bones in a market that demands a pristine story. They'll have viable levels eventually, but not yet. Oh, man, tonight, after the bell, we learned that recreational marijuana will be it's going to be on the ballot in Florida this November. No, really, not an April Fool's joke. Just happened. Despite canopy growth tumbling today, could this news be bullish for the stock? CGC? I'm talking to the CEO. Then several conglomerates are saying bigger isn't always better. So tonight, what we're going to do, I'm looking at the 3M news spinoff, telling you how to approach it. And I'm sitting down with Chipotle's top brass to find out more about this 50-for-1 stock split, what it means for the money, for your money, and, of course, what it means for the stock. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.